Welcome to another edition of the BFT Chat with me, Norvan and Acquah-Hayford. Today we are speaking to Hasan Khan. Hasan Khan is the head of transactional banking at the Standard Bank Group. And we'll be talking about transactional banking. We'll be looking at regulation within the banking sector in this country, payment systems, and how the impact of technology is on banking in Ghana. Many thanks to you, Hasan Khan, for joining us on the BFT Chat. Now, you are in charge of a sector within the Standard Bank Group, which will say not many, especially in Ghana, within the banking space, do know transactional banking. When we say transactional banking, what do we mean?
So what transactional banking means, we refer to internally in the bank as a business unit, and effectively, very simplistically put, it is effectively a piece of the bank that enables the clients to move money from one point to another. That is underpinned with people, processes, systems, disruptive technologies, but effectively, right at the heart of it is enabling a corporate client to move funds from one point to another, payments, collections, settlements. That's effectively what we do.
What's the difference between that and corporate banking? Because in Ghana here, we hear corporate banking a lot.
Yeah.
And then you say transactional banking, everything is transaction. Even me, who probably has some few coins with your bank.
It's a fascinating question, because the way we think about it, when we think about corporate banking within Standard Bank, we think about that as the client engagement, the client management part of the bank. So that's a group of individuals that engage the clients, understand the client's need. When you think about transaction banking, when you think about the other two business units, which are investment banking and global markets, our job is to partner corporate banking in ensuring that that client need is met by a set of solutions that the bank is developing and then deploying into the market. Equally, we are engaging the clients into direct dialogue. We are understanding their needs directly. We're not only getting it through the corporate banking team, but that's how you differentiate between the two. Think about corporate banking as client engagement, client management. Think about transaction banking as the group of individuals that manage the actual product that gets delivered to that client.
So, I mean, in my understanding, you are more customer focused.
Entirely. So the way we think about the bank, the way we think about the business or any part of the business of the bank is through three dimensions. The first one is we need an absolute obsession on clients. Everything we do has to be underpinned by a client question, a client need. And the clients have to sit at the heart of everything that we are thinking of and developing and deploying. The second thing we're starting to think about and rapidly propagate in the organization is everything has to be digital in nature. Anything we do has got to start with a digital mindset around how do we get this to the client in the most seamless, cost-effective digital manner that we can find. And the third is we want to truly be a universal bank to clients in all the markets we operate in. We are a bank that has aspirations to be a large wholesale bank and a large retail bank in all the markets we operate in. When you put the two of them together, we are very uniquely placed to bring to the market a set of solutions which apply to the client's entire ecosystem. You think about a large corporate client that sits at the center, and you think about all the buyers and the sellers that sit around it, which could be equally corporates themselves or could be SMEs. Our ability to think and design and deploy solutions across the entire ecosystem is what we believe a unique value proposition for Standard Bank.
Now, if I'm listening to you, I'm looking at, we are within times where one would say that commodity prices have been stagnating for some time after the free fall that we saw in the last year, 2 years ago. I mean, how do you ensure that you use this tool, which is the transactional banking, to get people to do what they have to do? And what has been its impact, the impact of the commodity stagnating, prices stagnating, also on your business?
So a couple of thoughts around that. The first one is talk about the commodity prices. I mean, you think about the last couple of years, you think about last year in particular, it has been an incredibly challenging year for the continent, for most of the markets across the continent. We do believe that the commodity prices this year will start to uptick a little bit, which will facilitate a much higher level of trade between Africa and the key corridors globally. What can we do, or what can the banking industry do per se within a market like Ghana to facilitate that level of ease back into the client base? A couple of things. The first one is, let's talk about interoperability. If you think about, as a end user, as a consumer, your ability to deal with 3 or 4 different banks is a bit more complex and harder than dealing with the same single financial institution. So if you're moving money to someone you know in bank A from bank B, it's a little bit more harder and complex than just moving money within the same bank. And the first thing that the banks have to do is allow for interoperability between each other much more easy, much more seamlessly. And that is incredibly important for the client or the end user experience to happen. There is a role that a regulator is playing and needs to continue to play by ensuring that the underlying principles that the banks need to adopt to operate with each other are consistent and equally adopted by all the banks within a particular banking landscape. And the third point I'd say is that about technology. There's a lot of disruptive technology out in the market, and we need to start thinking about it as, what can we actually benefit from and provide a more seamless integration to the client, rather than always viewing it as is that a real competitive threat? I do believe that there are pieces of technology out in the market that the banks can look at and deploy for greater client experience, which I don't think we are rapidly, as a banking industry, doing. So
why is it taking that long for us to get this interoperability to work for us, especially in our part of the world? Because these discussions started somewhere just last year in Ghana. Yeah.
So look, interoperability, if you think about it, it's an interesting question, because, and it depends on how much of what I'm about to say you end up using. But it is, a lot of this, the slower the money moves between 2 or 3 parts of the value chain, the more benefit it creates for financial institutions within that value chain. So if it becomes seamless, if it just moves from point A to B, instant pay is a great example, right? And I had a fascinating discussion with Gibbs yesterday around, does instant pay actually mean instant? And the answer was varied between yes and we're not sure. But if the money were to move between you and me instantly, then that float or that lazy set of balances do not exist anymore. And that's where the real trick is. That's where you start differentiating the value purely on your corporate banking client engagement, how you execute on the product, how you service it. That becomes your value proposition, as opposed to, it's hard really to move money from point A to B.
I see. Now let's look. We still stay with trade and its challenges. I'm very much aware that the Continental Trade Facilitation Agreement is supposed to come into force December this year. How do you think, what role will your bank play, especially to help Ghanaian businesses to take advantage of that?
So look, it has to be continuous dialogue, and it goes to the comment that I made a little bit earlier. It's about truly understanding the client's working capital needs. Once you understand what the client's buy and sell cycles are, is then coming up with a response to the client in terms of what risk appetite does the client need, when during the course of the year does the client need that, and what is the right product set within trade finance that helps the client meet that particular need. Really partnering the client and understanding what risk are they trying to manage. Are they trying to manage supplier or buyer risk? Are they trying to manage political risk? Are they trying to manage currency risk? And then coming up with a response that, or a set of products that help them manage that. This is kind of, it sits right at the heart of that client engagement conversation. The lesser the understanding that we have in terms of what the client wants to do, the poorer the match is going to be in terms of the product that the client gets. That's really the kind of, so the more time you spend, goes back to that, old adage around plan a lot and you'll spend a lot less time executing. But if you plan poorly, you're going to be spending a lot of time going back and forth. Really understand what the client needs, and then come back with a set of response that's simplistic and easy in nature.
This then brings me to my next question that says, do you think we are ready, especially Ghana or the African countries within the continent, to trade among each other? From where you said, you've dealt with so many businesses and transactional banking should help you to be able to say, look, you know what, we're ready to trade. But we are not. We still have challenges.
You see, the opportunity for intra-Africa trade to grow is incredibly large. And I think the short answer to your question is perhaps another question, which is, I don't see why not. We understand the neighboring markets or the markets on the continent better than we do some of the markets that we actually trade with today. We understand their similarities in terms of the volatile interest rate environments, the volatile currencies. There's absolutely no reason why we should not be able to understand and manage that through a set of products. Documentary trade, yes. Are we ready to move to just open account finance on an intra-Africa trade basis? I don't think so. I think that's a touch too early. Having said that, if you think about some of the markets in and around the SADC region, if you think about South Africa, you think about Botswana, you think about Namibia, there are large group entities operating in South Africa that have offices operating in Botswana. And albeit they are different legal entities, their trading principles are open account. There's very little documentary trade that facilitates movements of goods between those countries. Yet if you were to move between South Africa and Nigeria, or South Africa and Kenya, that's where the documentary trade piece kicks in. Look, documentary trade is designed to manage the three risks I said earlier. You know, you're not sure you're comfortable with the buyer and the seller relationship. You are not sure of the political risk, or you're not convinced of the currency risk. You can get comfortable as a client with those three. That gives you that threshold beyond which you can move into open account finance.
Open account is better than any other.
Open account is the most seamless way of doing it. It's cheap. There's very little documentation involved, and it is an effective means of settling a trade. But if you're unable to manage those three risks, which are effectively the buyer-seller risk, the political risk, or the currency risk, then you need to underpin that transaction with a documentary credit. One last comment on that. In some instances, if you pick Nigeria, for example, where access to foreign exchange is a challenge, is an ongoing challenge, and has been for the last 12 to 18 months. In those instances, it might be better to have an underlying documentary trade paper that explains to wherever you're going to go and source your dollars from, what that dollars are going to settle by way of a trade. There, an open account trade finance model might be a little bit harder to deal with.
Now let's go back to something you mentioned, the payment systems. I'm looking at the payment landscape in Ghana and within the continent. Let's bring it home to where we are. I'm sure you understand the Ghanaian market, having studied for some time. Do you think that we are ready? Or what sort of, let me put it this way, what sort of payment landscape do you envisage going forward for this country?
So there's a couple of things we can learn from. And I always say this to individuals in conversations, whether they're client or people in the bank or in the financial industry. You need to look at the evolution of the markets on the continent, in Asia, that have probably gone through these cycles 8 or 10 or 15 years ago. Where are we today? We've got, had a question at the GIPS meeting yesterday, has cash actually reduced? And the answer was no. Cash is at the levels that it was when we started doing these, when we started doing Easy Switch, GIPS, mobile money.
Yes, love cash.
Absolutely.
More than using cards.
We all in Africa love cash, right? It's the touch and feel of it. It's a feel of it. It's the security of we have something tangible in response for the completion of the trade. I don't think you get that feeling even looking at the account balance that you do get holding physical cash. But where are we now? I think it's an opportunity to partner, for the banks to partner GIPS in terms of thinking of what the payment landscape should look like, as defined by what the clients want it to be. This is what really should start shaping not just the payment landscape, but the industry as a whole, in terms of go and ask the client what they expect by way of product and what they expect the underlying experience to be. If you think about your smartphone, an Apple or Android, there's a lot of user input that goes into coming up with what that experience should be. So your user experience is already significantly well advanced in terms of what some of the banking products might be offering to you. And we need to start thinking about what your current user experience on non-banking applications is, and how does it shape what you expect a banking application to do. I want to make two more comments. One, I do think the mobile payment not just provides a huge amount of financial inclusion, so it allows you to go down to the real, consumer base with no bank accounts, and allows you to be able to facilitate payments between that, will leapfrog the traditional method. So it'll leapfrog clearly cash, checks, cards to a large extent, and that's what the focus needs to be. And the second point around that is interoperability between the mobile operators. So if you think about Airtel, MTN, and Tigo, the three of them, currently, and Vodafone, you're allowed to move money between your subscriber base. But if you're interoperable across all four of them, that as one consumer you have access to, I don't know, 25 million individuals that you could trade with and do a settlement with almost instantly. That is what we need to start thinking about and accepting that will be the reality going forward. What we have in transaction banking, and I repeatedly say this, a lot of people don't particularly enjoy the comment, is a set of commoditized products, is what every financial institution, every bank can do. The real differentiation is the client engagement, is understanding the client need and what you're providing, and is how seamlessly you can service it within the bank and deliver it to the client. Because the product will become increasingly commoditized, there'll be a lot of compression or demand from the client in terms of compressed pricing. So when you put all of these things together, you need to be able to provide a response to the client that is digitally enabled, seamless in its execution, and incredibly cost effective.
It sounds like technology is the way to go.
Absolutely.
Don't you think that we become technology adverse because of some of the things we hear, what we've read, the challenges with these things, cyber attacks all over. So these things put fear, and that's how come Africans, Ghanaians, want to feel their cash.
Look, so cybersecurity is real. Let's start with that. And there's a lot of effort that goes in on part of all the financial institutions in terms of managing it at various levels of the risk that sit within the cybersecurity sphere. I mean, you will have a lot of individuals, corporates, financial institutions that have had some level of experience of or an incident that they've had to manage as a result of cybersecurity. It is around continually creating that level of assurance back into the client base on what the banks, what the corporates, and what the clients need to do to manage this risk better. I mean, you think about cash, there's always a risk that somebody will take it off you. There's always a risk that somebody will run away with your bag. But we still find it a tangible means of settling trade between two parties. The underlying risks of cash have existed for tens of hundreds of years, but we still think it's a mode of settlement. The more understanding we create around cybersecurity and how we're going to manage those risks, the more confidence the clients will get around using the technology as a replacement to physical instruments such as cash and checks. It is unavoidable. We're going to evolve very quickly, and if we expect the experience to be seamless and incredibly cost efficient, we're going to have to reduce the level of human intervention and physical nature of settlement to be able to provide that to the client.
Now let's move to regulation. What's been the impact of regulation on your work at the bank?
So look, for the last 8 to 10 years in the evolution of transaction banking or the transaction banking landscape, that has been a constant. And the regulation has been, it's consistently changing, and it creates two levels of responses we need to create. We need to enable or engage the client in getting them to understand how they need to adapt and respond to it, what role they need to play, and then internally reconfiguring, readapting the organization to ensuring that we are aligned and compliant of all the changing regulation. And it's going to be an ongoing piece of work. It's not something that we're going to expect for it to become easier or end at the end of a particular year. We've just, as a financial institution, recognized that it's important. It keeps the level of stability within the industry that is required, and we just have to come up with faster ways of adopting it within the organization and ensuring that the clients understand what impact it creates on their end. If you think about FX regulations in markets like Nigeria, where you need a particular Form M before you can send money elsewhere, there's opportunities to engage the regulator on how we can make that easier. Should a Form M actually be digital in nature? But I think that the need for the Form M is still there. You're not going to get to a place where you'll convince a regulator that that particular piece of documentation is no longer required.
How has regulation affected the bottom line of banks? Because we're told that regulations are good, but some of them come and it's not good at all.
Look, so let's look at it slightly differently. Let's move away from the absolute question around the bank's bottom line. But has the cost of doing business gone up as a result of the increasing regulation? Absolutely. Cost of compliance has gone up. We need a lot more compliance individuals in a financial institution than we did 10 years ago. It will actually vary by financial institution. It will vary by what kind of business you're in. So assuming you are clearing US dollars into the US, you can expect that you will have a much higher, much more stringent set of regulations for that product set, i.e. clearing of dollars into the US, and there will be an associated cost with it. If you're not in that line of business, if you're a bank that is not a banker's bank, then you will not have that cost of carry. So it isn't consistent across financial institutions. But back to your question, does it mean that there is a larger cost of carry than it was 8 to 10 years ago? Absolutely. It's important. We must recognize that it's equally the right cost that the banks need to invest in, and it's not something that we should look at as a cost that, geez, we should much rather not have. So it is an incredibly important part of doing the right business the right way, and therefore we believe that we need to have it.
Even when I thought that regulators normally engage you guys a lot of the time, stakeholders, even before they come up with these regulations.
They do. And equally, we engage the regulators in continuous dialogue around shaping what we believe the next set of regulations should look like. Because effectively, they should allow for a more controlled operating environment, equally should not disable the growth of an economy or a business. That's important.
Okay, very finally, before I let you go, Hasan, I mean, what is the one thing that if you look at the Ghanaian banking landscape, you think that when it changes, we will see the number of unbanked reduce and then the banked going up? Because this is a country, you would agree, we have about 80% unbanked.
So look, financial institutions, the largest driver for financial inclusion is going to be technology, disruptive technologies that think completely unlike how I think. So I've been in this particular business for 20 years. I have come from the grassroots of doing transactional banking in a very traditional manner. So when as hard as I try and change every day that I start, my starting point is always to where I started from. But if you engage a 20-year-old, if you engage what they call the millennium, they'll tell you that we're thinking about it in a manner that we don't need to be thinking about it. We have to leapfrog the traditional settlement mechanisms or access to banking through branches, cards, physical cash in no particular order, into the zone of mobile apps, mobile banking. That will provide a real level of financial inclusion. That will see that 80% drop to 60, 50, or whatever desired levels we need to get at. And the beauty of this is that the challenge is no different in Ghana than it is to a Uganda or to a Mozambique or to a Namibia. Every market in Africa is dealing with the same challenge on how do we get greater level of financial inclusion and how do we get that rapidly. And here's an opportunity, my last comment, here's an opportunity for the banks to work together, to think together on this, because you're not trying to change the world of your client base. You're trying to change the world for everybody in a particular market. You're trying to change the landscape. And you cannot do that alone as 1, 2, or 4 financial institutions. You need to be able to do it as a collective body of financial institutions and how you fundamentally rethink and reshape the banking landscape.
Thank you very much, Hasan Khan, for
Thank
speaking
you.
to us on the BNFT
Thank you.
chat. That's how we end another edition of the BNFT chat with me, Norvan Acquah-Hayford. We've been speaking to Hasan Khan, who is from the Standard Bank Group in South Africa, or we'll say in Ghana, Stanbic Bank. We have been talking about the banking industry and various developments. There's a lot for you to chew on. Join us again in another edition next time. Goodbye.